Welcome to our lesson on balance sheets. Here we'll explore what a balance sheet is, why it's crucial, and the essential components that make up this statement. Let's dive in. Imagine checking your bank balance. It gives you an idea of the money you have, right? Similarly, a balance sheet shows you what a business owns, known as its assets, and owes, known as its liabilities. It's a snapshot of a company's financial position at a particular moment in time. While the profit and loss account gives insights into the financial performance over a period, a balance sheet reveals the financial status on a specific date. It's a bit like checking your pulse and blood pressure during a medical checkup. It tells you about the health of a business, its liquidity, and any potential risks it might face. Now, let's delve deeper into what makes up a balance sheet. Much like with the profit and loss account, the balance sheet is presented in a table, either as a single list starting with assets followed by liabilities or in separate columns for each. Here are the main components you'll come across. Current assets. These are assets that can be turned into cash at very short or no notice at all. Debtors, also known as accounts receivable. These are people or other businesses that owe you money and are included as a current asset. Fixed assets. These are assets that are purchased for long-term use for the production of its goods and services. Current liabilities. These are financial commitments of a business that are due and which a company must pay within 12 months. Creditors. Also known as accounts payable, these are businesses or individuals that we owe money to and are included as a current liability. Long-term liabilities. These are financial commitments of a business that are due more than 1 year in the future. And equity. This is the money generated by the business as well as money put into the business by the owners or shareholders. Another important term related to balance sheets, but not typically included on the actual document, is working capital, also known as net current assets. This is calculated by subtracting the current liabilities from the current assets, and shows how liquid the business is and its financial health in the short term. So, in this table we have total assets of £140,000 and total liabilities of £85,000. We also have equity of £55,000. At the bottom we've shown the total liabilities plus equity, which equals £140,000. You'll notice that it is equal to the total assets. This should always be the case and is the balance in the balance sheet. In conclusion, the balance sheet is a financial statement that shows the financial position of an enterprise. It does this by identifying its assets and its liabilities. The balance sheet can show the liquidity of the business, how efficiently it uses its assets and the financial risks the business faces. A balance sheet will include fixed assets, current assets, working capital, current liabilities, long-term liabilities, debtors, creditors, and equity. The total liabilities plus shareholder equity should be equal to the total assets. This is why it is called a balance sheet.